Hello, dear students. I see a lot of familiar faces and nicks in our conference. So probably some of you have not attended or not check in the course called Investment Project Management. So I will start with presenting myself. My name is Alexander Gorshenin, and I will run the course called Alternative Investments. I have a very good experience in working in specific fields of alternative investments like real estate and venture capital. So as already mentioned, the company TPS Real Estate, who runs several commercial retail malls, and the investment subsidiary of Transmash Holding, that subsidiary dealing with the venture capital projects in the fields of digital products and public mobility. So let us start with an overview of the course, and I will share my screen. Please let me know if you have any problems with sound, picture, or connection. We'll check and go on. So here we are. An alternative investment. And we have a bunch of learning objectives, meaning what the students should and can do after completing this course. First of all, you should be aware what are the types and the categories of alternative investments, and you can easily describe these categories. You can compare and differentiate alternative investments with respect to traditional investments. You should be able to explain investment in hedge funds, private equity, real estate, natural resources, infrastructure, and other alternative investments, including, as applicable, its strategies, describing its subcategories, describing potential benefits and risks, be able to understand and evaluate fee structure, and know the process of due diligence. And also you should be able to describe the potential benefits of alternative investments in the context of portfolio management, describe, calculate, interpret management and incentive fees on net of fees returns to hedge funds, for example. Describe issues in calculating returns on hedge funds, private equity, real estate, commodities, or other types of natural resources and infrastructure, and describe risk management of alternative investments. So let us start first session, an introductory session, during which we'll describe the categories and types of alternative investments. We'll compare it to traditional ones. We'll describe characteristic of direct investment, the process of co-investment, and the process of investment in funds. We'll describe investment and compensation structures commonly used in alternative investments and potential benefits of alternative investment in a context of portfolio management. So let us address a history of alternative investment. And throughout much of the 20th century, each institutional quality investment was evaluated primarily on the safety of its income and principal, and tended to be evaluated on a standalone basis. But beginning from the mid-50s and 60s, a modern portfolio theory established the mechanics and advantages of diversification. Modern portfolio theory evaluates risk on a portfolio basis. formalizing the idea that much risk can be diversified away by holding a broad mix of available investments. In 80s and 90s of the previous century, the appropriateness of investments for institutions increasingly began to be evaluated on a portfolio basis. The change in the law and investment practices from evaluating risk on a standalone basis to a portfolio as a whole basis is evidenced in this exhibit. So beginning in the 80s, inclusion of such assets as small company stock, low quality corporate bonds, and alternative assets became more common among financial institutions such as banks, pension funds, endowment funds, and insurance companies. Evaluated on a standalone basis, many of these assets had little or no reliable income and were at risk for loss of the original investment. But what held in portfolio, these relatively high-risk investments could lower the total risk of the portfolio because of their ability to provide improved diversification. This exhibit also indicates that institutions usually did not hold common stock prior to 1920. Most institutional quality investments more than 100 years ago were those secured by tangible assets, such as real estate. The underlying determinants of economic performance are changing with increasing speed. Take, for instance, the composition of the major stocks in the United States in early 19th century, 20th century. The Dow Jones Industrial Average included 12 stocks, 10 common stocks, and 2 preferred stocks. Almost every one of these 12 stocks was a commodity producer, like copper, sugar, tobacco, paper, lead, coal, leather, rubber, and steel. But by 1960, the top 7 Fortune 500 firms in the United States were General Motors Company, Standard Oil Company, Ford Motor Company, General Electric, United States Steel, Mobile, and Gulf Oil. The list included 3 oil companies and 1 steel company, as well as 2 automobile manufacturers and 1 electrical equipment manufacturer. Now, top firms are dominated by services and technology. The top 5 US firms in terms of market capitalization in the year 2017 were Apple, Alphabet, Microsoft Corporation, Amazon, and Berkshire Hathaway. Facebook was 7th with market capitalization of more than 500 billion, no inventory, and fixed asset of only about 10 billion. And now we can see the Tesla, who is also costs billions, but again, the ratio of the book value to earnings to price is about from 200 to 300, and book to price is even more. So clearly, it is inappropriate to view traditional assets as solid and alternative assets as speculative. But of course, there is a different point of view that can say that, okay, the alternative investment has an embedded high risk profile. That's why it sometimes can be called speculative. But from our academician point of view, we should say that it is a high risk profile that is embedded in alternative investments, but they are not speculative in nature. They should be treated as a means of diversifying the overall total portfolio risk. Investments closely tied to commodity prices are now viewed as an alternative investments. Yet they constitute most of the industrial investment opportunities in previous century. With such dramatic and increasingly rapid changes in the commodities or in the components of an economy, it is difficult to conclude that conservative and traditional investment principles consist of maintaining unchanging investment practices. In effect, sticking with traditional investment practices moves the risk and diversification of portfolios through time as the economy underlying the investment opportunities shifts. It is only through a dynamic approach to asset allocation that a portfolio can maintain good principles of diversification. So let us consider why investors, let us check why investors consider alternative investments. The growth has largely occurred because of interest of these investments by institutions such as endowment and pension funds, as well as high net worth individuals seeking diversification and return opportunities. Alternative investments are perceived to behave differently from traditional investments. Investors may seek either absolute return or relative return. Some investors hope alternative investments will provide positive returns throughout the economic cycle. This goal is an absolute return objective. Alternative investments are not free of risk, however, and their returns may be negative or correlated with other investments, including traditional investments, especially in the periods of financial crisis. Some investors in alternative investments have a relative return objective. A relative return objective, which is often the objective of portfolio of traditional investments, seeks to achieve a return relative to an equity or fixed income benchmark. And assets under management in alternative investments have grown rapidly since the mid of 90s. This growth has largely occurred because of the interest in these investments from institutions such as endowments, as we said, and from family offices seeking diversification and return opportunities. Alternative investments offer broader diversification because of their lower correlation with traditional asset classes. Opportunities for enhancing returns by increasing the portfolio risk-return profile and potentially increased income through high yields. For example, the annual 2019 report for Yale University Endowment provides one institutional investor's reasoning behind the attractiveness of investing in alternatives. The heavy, around 75% allocation to non-traditional asset classes stems from the diversifying power that provide to the portfolio as a whole. Alternative assets, by their very nature, tend to be less efficiently priced than traditional marketable securities, providing an opportunity to exploit market inefficiencies through active management. Today's portfolio has significantly higher expected return and lower volatility than portfolio of 1989. So this quote from a statement of Yale University. And this quote neatly illustrates the expected characteristics of alternative investments. It is diversifying power, higher expected returns, and illiquid and potentially less efficient markets. These links also highlight the importance of having the ability and willingness to take a long-term perspective. Allocating a portion of an endowment portfolio to alternative investment is not unique to Yale. INSEAD, as of April 2020, had allocated 1/3 of its endowment to private market strategies, including private equity, private debt, and real estate. These examples are not meant to imply that every university, endowment fund invests in alternative investments, but many do so. Family offices have also embraced alternative investments. According to Global Family Office Report of 2019 from UBS, over 30% of average family office portfolio was invested in alternative assets. According to Willis Towers Watson Global Pension Asset Study 2020, the typical pension plan has 23% allocation to alternative investment at the end of 2019. Alternative investments are not free of risk. And over a long historical period, the average correlation of returns from alternative investments with those of traditional investments may be low, but in any particular period, the correlation can differ from the average. During periods of economic crisis, correlations among many assets, both in alternative and traditional, can increase dramatically. And from my experience, I work in a family office that was both true for TPS Real Estate and Transmash Holding, who deals 100% with alternative investments. In one case, it was a real estate, and in another, it was venture capital. So you can see very extreme examples of setting up a home offices, even in Russia. Let us try to describe types and categories of alternative investments. Alternative investment is a label for a disparate group of investments that are distinguished from long-only publicly traded investments in stocks, bonds, and cash. That is often referred as a traditional investment. The terms traditional and alternative should not imply that alternatives are necessarily uncommon, or that they are relatively recent additions to the alternate investment universe. Alternative investments include such assets as real estate and commodities, which are two of the oldest types of investments. Alternative investments also include non-traditional approaches to invest within special vehicles, such as a private equity fund or hedge funds. These funds may give the manager flexibility to use derivatives and leverage to make investments in illiquid assets and to take short positions. The assets in which these vehicles invest can include traditional assets, stocks, bonds, cash, as well as less traditional assets. So please keep in mind that there is two possible approach how to differentiate the alternative investments from traditional ones. It's about the asset class, and the second approach is to differentiate using the investment vehicle. The management of alternative investments are typically active. Alternative investments often have many of the following characteristics: narrow specialization of the investment managers, relatively low correlation of returns with those of traditional investments, less regulation and less transparency than traditional investments, limited historical risk and return data, unique legal and tax considerations, higher fees, often including performance or incentive fees, concentrated portfolios, and restrictions on redemptions, that is, lockups and gates. Alternative investments, particular investments through special vehicles, are often characterized by high fees, concentrated portfolios, high use of leverage, and restriction on fund redemption. And we can see that high net worth investors have also embraced alternative investments. And according to research of Spectrum Group in 2014, 42% of American investors with more than 25 million in assets have invested in hedge funds, and 69% of investors with more than 125 million have invested in hedge funds. The author of this research noted that while the investors were choosing alternatives for higher return and improved diversification, the increasing interest in alternative investments by both institutional investors and high net worth individuals has resulted in significant growth in each category of alternative investments since the beginning of 21st century. The following example illustrates growth in the categories of private equity, real estate, and commodities in a period up to 2015. A global private capital fundraising was approximately 600 billion in year 2014, compared with around 238 billion in the beginning of the 21st century. The global REITs, that is real estate investment trust, grew from 1.8 trillion in market value by September 2015. In 1990, the market capitalization of global REITs was less than 10 billion, so it's a 200-fold growth. The number of new commodity trading advisors averaged 169 annually for the 5 years ending 2013, compared with only 33 for the 5 years ending 2004. So it, again, 5 times growth. The enthusiasm for alternative investments was tested during the crisis of 2008, when assets under management in alternative investment declined as losses was incurred and investors withdrew funds. However, alternative investments continue to represent a significant proportion of the portfolios of pension funds, endowments, foundations, and high net worth individuals. By 2012, a resurgence of interest in alternative investments occurred. The alternative investments available, varying characteristics and performance and suitability for investor has to be carefully considered. And what we can see in a recent couple of years, we have advocated the phenomenon of emerging a new class of assets that, from my perspective, belong to the universe of alternative investment. It's a cryptocurrency and all the derivatives based on the cryptocurrencies, and even specific companies working in an industry of cryptocurrency like Coinbase, Binance, etc., that goes to the public market. And I can hardly say that there is any person on the planet that knows nothing about this extra growth of the revenues and the capitalization of companies, cryptocurrencies, etc. But at the same time, I want to be sure that I'm not wrong in my perception that any of investors in the cryptocurrency aware about of the risk connected with the investing into cryptocurrencies. So from my point of view, there is still no proof for any kind of cryptocurrencies that it cannot be easily switched off, and you cannot lose all of your investment. So still there is an issue about what will be the mitigation of any defaults in case of investment into cryptocurrency or related companies or related businesses. And I see a question from chat. So again, it's about how the final grade will be calculated for this course. We have pretty same approach as for the course investment project management. So we have a final score that is calculated using 3 components. It's participation in classes, homework, or some intermediate test, and the final exam. We have slightly different weights for these scores. So 10% for the home participation, 30% for the homeworks and the intermediate tests, and 60% for the final exam. That's what it is mostly due that the alternative investments need a lot of material to digest, and if we can have as much as it possible tests done during the course, it will definitely help you to improve your knowledge and to solidify your knowledge. So we'll have a pretty same approach for testing. So by the end of each session, we'll have first a sample test that will be paced with me. Then you will have a test that will be opened by the end of the session, and you will be able to answer until the next session. So generally it will be open for 5 to 6 days. So no problem with accessing these tests, no problem with answering, I think, and you shouldn't be afraid from getting some bad or wrong answers in this test, because the primary focus for this test is to check your knowledge, and you have multiple passes, tries to pass this test. So please don't be worried if you have some difficulties answering. We will have a time in the beginning of each session to look through the answers, look through the questions, and if you have some problems, you can raise a hand, and I will explain what exactly mean by that or this question, and that's how we'll build our knowledge. So any other questions regarding the course, the scores, the schedule, etc., please raise a hand or type in the chat. I will be glad to answer you. Let's move on. And the quizzes will be graded, but very softened. So the threshold of passing each quiz will be low. So you shouldn't definitely answer correctly all the quizzes. And we will have, I think, the in the middle of the course, we'll have some extended intermediate test that we can pass together with me in the classes. So we'll pay more attention for this intermediate test, while the test that will be opened after the end of each session is more like concept checkers for you, and again, it's some indication of your participation in the sessions. Okay, fine. Let's move on. Let us describe categories of alternative investments. So there is really no consensus exists given to what represents category or subcategory of alternative investments, but considering the variety of alternative investments, it is not surprising that such consensus no exists. There is even considerable debate about categories and subcategories. So what should consist a category, or what should be detailed as a subcategory, or vice versa. The following list here offers one approach to broad category definitions, and each category is described in detail later in our sessions. And I should say that it is approach that employed by CFA Institute, and we have another association called the CAIA, that is Chartered Alternative Investment Analysts. They have a slightly different categorization of alternative investments, but please do not worry. In the principle of having the same characteristic features of alternative investments, all associations are come to the common ground. So the hedge funds. Hedge funds are private investment vehicles that manage portfolios of securities and or derivative positions using a variety of strategies. Although hedge funds may be invested entirely in traditional assets, these vehicles are considered alternative because of their private nature. Hedge funds typically have more leeway to pursue investments and strategies, offering the potential for higher returns, whether absolute or compared with a specific market benchmark, but these strategies may increase the risk of investment loss. They may involve long and short positions and may be highly leveraged. Some aim to deliver investment performance that is independent of broad market performance, like it's also called alpha seekers. Then the private capital. Private capital can be performed using two types of provided using two types. It's the equity capital or debt capital. So private equity. Investor participate in the private equity through direct investment or indirectly through private equity funds. Private equity funds generally invest in companies, whether startups or established firms that are not listed on a public exchange, or they invest in public companies with the intent to take them private. The majority of private equity activity involves leveraged buyouts or established profitable and cash-generating companies with solid customer base, proven products, and highly quality management. So the general approach for the LBOs, it is a abbreviation for leveraged buyout. You found the company that is private, that is undeveloped for some reason, but probably because of distress, some problems with its management, problems with products, problems with supply chain, etc. But you can find a potential for improving its performance, like removing or separating some product lines, optimizing the management structure, the organizational structure, selling needed real estate assets, like you don't need some specific property, or you can sold your, for example, as was in many cases in former Eastern Europe, you can sell your non-core assets, but that constitute your social environment, like these summer camps for children, hospitals, sanatoriums, etc. They will not bring the revenue for your core business, but it costs a lot. It can be sold or it can be redeveloped, etc. So that's one that the LBOs done during the process when they manage the buyout company. Then, when all things go well, they repay the debt employed to take over the company and go public and sell it away. And in the session next week, we will see very dramatic examples of such LBOs that was done in recent decades. Then we have private debt, and the private debt largely encompasses debt provided to private entities. Forms of private debt include direct lending, private loans with no intermediary, mezzanine loans, private subordinated debt, venture debt, private loans to startups or early stage companies that may have little or negative cash flow, a distressed debt, debt extended to companies that are distressed because of such issues as a bankruptcy or other complications with meeting debt obligations. And venture capital funds, a specialized form of private equity that typically involves investing in or providing financing to startups on a early stage companies with high growth potential, represent a small portion of the private equity market. So the greatest portion of the private equity market is the LBOs. And the real estate. Next slide. Real estate. Real estate investments are made in buildings or land, either directly or indirectly. The growing popularity of securitizations broadened the definition of real estate investing. It now includes private commercial real estate equity, that is ownership of an office building, private commercial real estate debt, that is directly issued loans or mortgages on commercial property, public real estate equity, that is real estate investment trusts or REITs, and public real estate debt, that is mortgage-backed securities. We have a very interesting category of alternative investments called natural resources, and it was the broadened in the academician circles in recent years. So now the academicians consider the natural resources category not only for commodities, that was a historical approach, but also agricultural land or farmland and timberland. Commodity investments may take place in the physical commodity products such as grains, metals, crude oil, either through owning cash instruments using derivative products or investing in the businesses engaged in the production of physical commodities. The main vehicles investors use to gain exposure to commodities are commodity futures contracts and funds benchmarked to commodity indexes. Commodity indexes are typically based on various underlying commodity futures also. Then that is agricultural land or farmland. Agricultural land is for cultivation of livestock or plants, and agricultural land investing covers various strategies, including the purchase of farmland in order to lease it back to the farmers, or receive a stream of income from the growth, harvest, and sale of crops, for example, corn, cotton, wheat, or livestock like cattle. Timberland. Investing in timberland generally involves investing capital in natural forests or managed tree plantations in order to earn a return when the trees are harvested. Timberland investors often rely on various drivers such as biological growth to increase the value of the trees so the wood can be sold at favorable prices in the future. And you can see in this year and the previous one that timberland investment is very good in comparison to investment in farmland or agricultural land because it has an embedded property of warehouse. If you have your trees that grows on average 10% a year, and you have no favorable prices on the market, you can store your wood. You can allow trees to grow, not cut it down, not sell on the market. But then we have very good prices, like in this year, we have 7 times fold hike in wood and some products from wood. That was a very good time for timberland companies and wood processing companies to earn the profits. And now when prices are going down, they can keep their wood going, not selling until the next hike in the prices. While you can do so in agricultural land, if you have a your bananas, for example, your fruits grown, you cannot not selling it right now this season because they will be just destroyed by the pass of time. Infrastructure. Infrastructure assets are capital intensive. Long-lived real assets such as roads, dams, schools, and are intended for public use and provide essential services. Infrastructure assets may be financed, owned, or operated by governments, but private sector investment is on the rise. So, not going further, can any one of you type in chat or say it by words using the knowledge from our previous session on investment project management? What is the common approach for infrastructure investing for both public authorities and the private companies? Any ideas? Please recall this first session on investment project management. Can't recall? Or it is called public-private partnerships, in which governments and investors each have a stake. Infrastructure investments provide exposure for asset cash flows, but asset itself is generally part of a long-term concession agreement, ultimately going back to the public authority. Investors may gain exposure to these assets directly or indirectly. Indirect investment vehicles include shares of companies, exchange traded funds like that's called ETFs, private equity funds, listed funds, and unlisted funds that invest in infrastructure. There is other part of the universe of alternative investment called other alternative investments that may include tangible assets such as fine wine, art, antique furniture and automobiles, stamps, coins, and other collectibles, and intangible assets such as patents and litigation actions. And just to mention that Warren Buffett is a fund of investing in collectibles. So he collects the cards for the baseball players and the stamps. And he has a very huge collection, and he treats not only as a collection but as an investment. Let us have a short break now for 5 to 10 minutes to make a cup of coffee, and then we'll go for the issues of comparison and differentiation alternative investment with traditional investment. So have a break for 5 minutes. Meanwhile, if you have any questions regarding course, regarding exams, or anything else, please type in any chat. Okay. Luca, thank you for your question. I will share the link to our investment project management quiz, but I will do it after the current session and after current quizzes, because I'm run the quizzes on separate accounts for these two courses. So one special account for investment project management and another account for alternative investments. Please write down your email in the chat and I will send the link directly to you. And I will also share my email here. So if you have any questions regarding the course, the quizzes, or anything else, you can mail directly to me. So here. Okay, let's move on. And I would like to present you this so-called a quick sheet that will definitely help you in getting prepared for a test or exams and to fresh up your mind and recalling any principles, types, etc. So key facts about the alternative investment. So here we have the differentiation principles between alternative and traditional investments. We have categories shown here. It is a hedge funds and the private capital and its differentiation between the various types of the private equity companies. On the next slide, we have a real estate with various types of real estate, and we will discuss in detail all these types in coming sessions. We have natural resources with one part devoted to commodities and various vehicles you can employ to get an exposure to commodities, and this land that is farmland, agricultural land, or timberland. We have an infrastructure, they have a dichotomy of economic infrastructure and the social infrastructure, and we have other types of investment. Needless to say that from my perspective, we can already add as a separate class or as a subclass of other types of alternative investment, the cryptocurrency and other companies or businesses and processes connected to the cryptocurrencies. But it is a matter of a separate discussion, and we will go to the ecology of alternative investments. So it's very popular now to talk about the ecosphere of anything, of company or product or business, etc. Let us also talk about the ecology or ecosphere or eco-environment of alternative investments. So when alternative investments are supported by a host of service providers and governed by regulations which can significantly differ by location. And here we consider the glossary of terms defining the facets and complexities that make up the alternative investment ecospace. Traditional investments are generally long-only, publicly traded, and highly regulated assets. As a result, traditional asset overseers often have less need for knowledge regarding underlying such issues as the safekeeping of assets. Alternative assets are often less regulated, more complex, and private. As a result, overseers of alternative assets often need to be familiar with such issues as the safekeeping of assets, borrowing facilities, and third-party service providers. The terms that follow provide the foundation for the knowledge needed to oversee a diverse portfolio of alternative investments. What are the key contributors? Depositories and custodians. Depositories and custodians hold customer securities for safekeeping and may perform additional activities such as settlement, tax withholding, and proxy voting. Asset allocators need to consider depositories and custodians not only in the context of the securities that they hold, but also with regard to understanding the safekeeping of assets underlying the investment pools in which they invest. Fund administrators. Fund administrators are specialists that serve numerous roles, including protecting the interests of fund investors by determining the fair pricing of securities and funds. Fund administrators are also responsible for preparation of annual reports, settlement of securities, payment of fund expenses, and the computation of fund performance measures involved in the fund management. Plan sponsors, it's more for the global investors in alternative investments, but we should know about it. The plan sponsors is an entity that organizes retirement plans such as a pension plan for the benefit of the plan's participants. Other responsibilities of the plan sponsor include determining membership parameters and investment choices. The term plan sponsor is sometimes broadly used to include other asset owners, such as educational endowments, charitable foundations, and sovereign wealth funds. And also very important contributor, prime brokers. Prime broker is a brokerage firm that provides a suite of services to investment pools, such as hedge funds. The most important service is financing the hedge funds' positions and trades. That is, brokers lend to the hedge fund. Other services provided include access to complex securities, technology, consulting, and advisory work. Asset allocators should review the capabilities of the prime brokers that are servicing the hedge funds and other investment pools in which they invest. The complexities of heavy trading, shorting, and leverage make the prime broker an essential component of the hedge fund operators. And we know that the global banks are always eager to provide this prime brokers service, needless to say. And we also can look at Russian financial market. We already have a very good prime brokers that provide all the variety of these services. For example, Alfa Bank, Sberbank, VTB, Kritia, etc., Tinkoff. So no problem with that. What is this operations? It is financing. Although traditional investment managers are mostly long only and often use little or no margin, many hedge funds make frequent use of short positions, which requires borrowing of assets and margin. The prime broker meets the needs of the fund's trading strategy by arranging a clearing facility so the collateral requirements can be met across all products simultaneously. The complex securities. Prime brokers facilitate access to the diverse array of products used by many hedge funds, including swaps, futures, forwards, options, which are typically not available through traditional brokers. Prime brokers offer services related to the International Swaps and Derivatives Association master agreement, a service agreement for the OTC over-the-counter derivatives that sets the terms for both sides of the contracts. We'll talk in detail about the derivatives in the next session. The technology processes. Key information across multiple asset classes is offered through the prime broker platform, which authorizes cash wires, facilitate elections on corporate actions, exercise options, and reconciles individual trades. And consulting and advisory. Prime brokers often introduce hedge fund clients to qualified investors, a service called capital introduction. Advise new hedge funds on the regulatory requirements in different jurisdictions, and assist in the establishment of risk management platforms. Another very important, especially in the recent years, contributors to the universe of alternative investments, it's risk managers. Reporting to the chief risk officer, fund risk managers design systems to identify, quantify, monitor, prioritize, and report aggregate fund risks to investors and counterparties. The main objective of risk system is to place controls such that of the collective risks do not jeopardize the functioning of the business. And I want to share with you my personal view based on my communication with my fellow colleagues and my other friends from the industry, that the demand for professionals in this area, the area of technology and area of risk management, is constantly growing in recent years. So compared to the, even if we compare the traditional professionals employed in funds, hedge funds, etc., like manager of accounts, some analysts, etc., and these new professionals in the industry, like IT staff, risk risk managers, the salaries was higher for like account managers, analysts in the hedge funds 10 years ago. They became equal to the salaries of IT staff and risk manager staff, say, from 2 to 3 to 5 years ago. And now we have the salaries for IT staff and risk managers that exceeding the average salary for financial analyst. And we have a discussion recently with Vladimir Potapov, who is the head of VTB Capital Asset Management, and he explained that even in such huge bank organization, already the salaries of IT specialists that is not deeply involved in a processes of managing the assets, but good in providing a good IT platform, building a very favorable and easy user interface, and to smooth the user experience, already receive a salaries higher than the even chartered financial analysts. So the world is always changing, and we see that the calls of from the industry are always resulted in responses from the professional societies. Let's move on. And we also have another part of the ecosystem of alternative investment. It is the key elements. What are the key elements? Back office operations. The back office, as opposed to the client-facing and revenue-generating front office, is responsible for a variety of services required to keep the company in operation. Primary back office services include trade settlements, technology infrastructure, and compliance. And the demand for this office is growing, growing, and growing. Buy-side institutions. The buy side is composed of financial institutions that operate both in the traditional side of investments, for example, pension funds and insurance companies, and in the alternative investment space, for example, foundations, sovereign wealth fund, and private investment pools, such as hedge funds and master limited partnerships. Buy-side analysts build portfolios for their clients that meet specific needs, such as the duration matching of assets or to liabilities or alpha generation. The family offices, offering guidance and financial services for high net worth individuals. The family office operates either for a single family or in the service of multiple families. In essence, family offices are investment management firms organized for individuals with wealth so substantial that professional investment managers are retained in-house. In addition to executing detailed financial plans, family offices deliver financial education and philanthropy planning for current and future generation. And I have luck to work in the two family offices that was explained earlier. Front office operations. As opposed to the operational support of the back office, the front office is outward facing and responsible for revenue generation. Front office roles include sales, portfolio analysis and management, trading and business development. Then we have a management company operating agreements. Private investments, such as most hedge funds and private equity funds, involve legal documents that are not used for positions in public securities. Similar to corporate bylaws, operating agreements are legal documents that govern the business structure of the limited liability corporation and define the rights and duties of the LLC constituents. The operating agreement specifies the separation between the company and its owners, as well as rules and regulations for the smooth separation of the businesses. Very important aspect, the concept is the partnership agreements. Private investments, such as most hedge funds and private equity funds, involve legal documents that are not used for positions in public securities. Partnership agreements are complex legal documents that outline all terms between the fund's limited partners, the investors, and the fund's general partner, the manager. The partnership agreement spells out the precise fees and expenses paid to the general partner, the allocation and distribution of profits to the general and limited partners, withdrawal provisions, lockups, and any imposed gates. We'll discuss later what is a withdrawal provision, what is lockups, what is a gates, etc., etc., etc. Private placement memoranda. Private investments, such as most hedge funds and private equity funds, involve legal documents that are not used for positions in the public securities. Again, similar to a prospectus, private placement memorandums, also called offering memorandums, give investors much of the information necessary to make informed investment decisions. These memorandums provide the background of the management team and describe the business plan, the pro forma financials, the legal details with respect to the liabilities of the company, and rights of the investors. And also I have sell-side institutions. The sell-side, as name suggests, consists of the institutions that engage in the sale of security to investors. Research analysts guide sell-side activities by building performance models, preparing earnings forecasts, and making investment recommendations. The sell side is dominated in terms of activity by large dealer banks such as Deutsche Bank, Goldman Sachs, Bank of America Merrill Lynch, Credit Suisse Group, etc., etc., etc. And very active now in this universe of alternative investment, it is a sovereign wealth fund. Sovereign wealth funds are state-owned investment pools structured to stabilize national budgets and secure wealth for future generations. At least it is stated in the memorandum. Sovereign wealth funds are most prevalent in the countries with large natural resources or a volatile balance of trade and foreign currency reserves. With the objective of increasing savings to future generations, sovereign wealth funds have a long-term investment horizon and typically operate with the goal of achieving a total return that is greater than can be earned on a foreign currency reserve. For example, Norway uses its large sovereign wealth fund to finance rising public pension expenditures and to contribute to intergenerational equity. Given Norway's enormous balance of payment surplus, this sovereign wealth fund portfolio tilts towards global equities and real estate to diversify away from investment factors that underlie oil reserves. Subscription agreements. Investors joining limited partnerships must file applications known as subscription agreements. In addition to documenting the investor suitability to invest in a partnership, the agreement will specify terms with respect to liquidation and termination. Once filed, the general partners must decide to approve the application. That's a brief overview of key elements and key contributors of ecosystem of alternative investment. And lately, you will have all the notes for the sessions at your hand. I intentionally not giving you it right now because it will give you some additional motivation to recall the sessions and to analyze what has happened. By the middle of the course, you will receive the slides for the sessions that passed, along with notes where you can find all this detailed description of elements, contributors, and etc., etc., etc. And now I would like to ask you to have a paste quiz together with me to check your knowledge for this first part of the session. I will open the Socrative and launch a quiz. Okay, that's cool. I will share the room with you. Please enter the room. Can you enter the room? Please let me know. Can you enter the room for quiz or not? Okay, the link is here. I will repeat it again. Sorry, I will go. It probably comes as a private message. I will it comes here. Please check. I see you're entering. We have 38 participants in our Zoom conference. So let us move from one question to the next until we have, unless we have 30 participants answered, to have maximum audience able to answer the questions. It's very simple questions. It's more like knowledge checks. So don't worry if you answer it wrongly. No problem with it. We need so we have 100%, oh, less than 100 answered, but again, okay, 30 students answered. So alternative investment focus solely on the private markets. It's false, of course. Although many alternative investments are focused on the private market, that alternative investments such as hedge fund that focus on the public markets, but use the vehicles that are alternative in nature, like taking short positions, using leverage, etc., etc., etc. Go next. Just put anything here you think the answer can be. So it's open question, no problem with any type of answer. Please make up your mind and try to answer. I will give you more time for this question because, okay, it's need more time to type in the answer. No problem with that. Okay, we reached the threshold. let us share the answers. Yeah, most of you are correct, and you can check it against my answer. So the majority of private equity activity involves leveraged buyouts of established, profitable, and cash-generating companies with solid customer bases, proven products, and high-quality management. So good. I see a lot of LBOs here. Fine. Move on. Okay. Yeah, very good. Of course, long-only equity funds is least likely to be considered as an alternative investment. Next one. Okay. Yeah, perfectly. A hedge fund is the best for this reason. Okay. Nearly perfect. Yes. Alternative investments are characterized as typically having low level of transparency. It's really hard to find the disclosure for alternative investments vehicles. Okay. Yes, it's pretty simple and straightforward question. Alternative investment funds are typically managed actively. Fine, 100%. Yeah, good. And the last one in this quiz. Cool. Oh, good. Yeah, here is the explanation. So, how it was? Hard or not? Easy or not? What was the most difficult question with open answer, I think? What do you think? Yeah, good. So let us have break now, maybe a bit longer. Let's meet at 8:05, and we'll have the second section of our session that we'll discuss the methods of investing in alternative investments, the legal arrangements, and the fees and other types of revenues and remuneration that are used in this area. So have a break, make yourself a cup of coffee, tea, or have a snack, just relax for a bit, and we'll continue in 7 minutes. Hello. So let's move on. What are the methods of investing in alternative investments? In a fund investing, so there is three broad types: fund investing, co-investing, and direct investing. In fund investing, the investor contributes capital to a fund, and the fund identifies, selects, and makes investments on the investor's behalf. For the fund services, the investor is charged a fee based on the amount of the assets being managed, and the performance fee is applied if the fund manager delivers superior results. Fund investing can be viewed as an indirect method of investing in alternative assets. Fund investors have little or no leeway in a sense that the investment decisions are limited to either investing in the fund or not. Furthermore, fund investors are typically unable to affect the fund's underlying investments. Note that the fund investing is available for all major alternative investment types, including hedge funds, private capital, real estate, infrastructure, and natural resources. Oops, I'm going. Okay. Then in co-investing, the investor invests in assets indirectly through the fund, but also possess right, known as a co-investment right, to invest directly in the same assets. Through co-investing, the investor is able to make an investment alongside a fund when the fund identifies deals, and the investor is not limited to participating in a deal solely by investing in a fund. This exhibit illustrates the co-investing method. The investor invests in one deal, in this case labeled investment number 3, indirectly via fund investing, while investing in additional amount directly via co-investment. And direct investing occurs when an investor makes a direct investment in an asset. In this exhibit labeled investment A, without the use of an intermediary. In private equity, this may mean the investor purchases a direct stake in a private company without the use of special vehicle, such as fund. Direct investors have great flexibility and control when it comes to choosing their investments, selecting their preferred methods of financing, and planning their approach. The direct method of investment in alternative assets is typically reserved for larger and more sophisticated investors, and usually applies to private equity and real estate. Sizable investors such as major pensions and sovereign wealth funds, however, may also invest directly in infrastructure and natural resources. Institutional investors typically begin investing in alternative investments via funds. Then, as they gain experience, they can begin to invest via co-investing and direct investing. The larger and more sophisticated direct investors compete with fund managers for access to the best investment opportunities. Let us discuss advantages and disadvantages of the various methods of investing. The primary advantages of fund investing include the professional services offered by fund managers, a lower level of investor involvement, and access to alternative investments without prerequisite of advanced expertise. Additionally, diversification benefits stem from the multiple investments found in a single investment vehicle overseen by a fund manager. Fund investing in alternative assets demands less participation from the investor than the direct and co-investing approaches. Because of it, it is up to the fund manager to identify, select, and manage the fund's investments. The investor may also heavily rely on the fund manager to carry out the due diligence that accompanies the investment process. Finally, specialist fund manager may expand the investment universe for an investor who lacks expertise for the sector in question. But again, there is a disadvantages of fund investing. Fund investing in alternative investments is costly because the investor is required to pay management fees and performance fees that are typically higher than fees for traditional asset classes. The higher fees can be attributed to the increased cost of running an alternative fund that may have a more complex strategy or require more skills and resources to conduct due diligence and manage opportunities that have limited publicly available information. Alternative managers may also command higher fees if they face little competition, despite the fact that a fund may provide due diligence expertise. When it comes to choosing investment, an investor is still required to conduct thorough due diligence when selecting the right fund in the first place. Selecting the right fund itself is not an easy task because of asymmetry of information. So when you invest in fund, you definitely know less than fund managers. What about co-investing? Co-investing are essentially engaging in a hybrid of direct investing and fund investing. Can learn from the fund's process and leverage the experience they gain to become better at direct investing. Many institutional investors begin with fund investing because it provides instant diversification while requiring less costly minimum participation levels and less due diligence. As investors' investment expertise and experience and investable assets grow, they may be granted co-investment rights with an investment in fund, giving them a taste of direct investing. It works as follows. Alongside the fund's direct investment, investors co-invest in additional amount into the same investment, often without paying a management fees on the capital they used for the direct investment. Compared with fund investing, co-investing allows investors to be more actively involved with the management of their portfolio. Later, as their experience and capital increase, investors may prefer direct investing, bringing their expertise in-house and avoiding fund management fees. So that's all about the balance of your expertise and the amount of fees you're able to pay for the manager of fund. And disadvantages of co-investing. Co-investors have reduced control over the investment selection process and may be subject to adverse selection bias, where the fund manager make less attractive investment opportunities available to the co-investor while allocated its own capital to more appealing deal. Co-investing furthermore requires more active involvement from the investor, who must evaluate both investment opportunities and the fund manager, which demands more resources, consecration, and expertise. Moreover, co-investors usually have a limited amount of time to make a decision to invest or not. The co-investing approach can prove to be challenging for smaller firms with limited resources and due diligence expertise. So it's like some compromise between the investing using fund and direct investing. You need more expertise, but you'll pay less fees. And direct investment. When an investor chooses direct investing, he avoids paying ongoing management fees to an external manager because the investor conducts the investment process on her own, bypassing the use of special vehicles such as the fund. And direct investing allows the investor to build a portfolio of investments to her exact requirements. Direct investing provides the greatest amount of flexibility for the investor and grants the highest level of control over how the asset is managed. For example, an investor who directly purchases an ownership stake in a business typically has the ability to influence important matters such as selection of manager team and controlling the strategic direction and investing decisions of the company. But also have a disadvantages of direct investing, that is, compared with investing via fund and co-investing, direct investing demands more investment expertise and a higher level of financial sophistication. Such experience would otherwise be provided by a fund manager or investment firm during the complex investment and the management process. Concentration increases risk. The direct investor won't enjoy the ready diversification benefits of fund investing. It would require time and resources for an investor to mirror this advantage through direct investment. For example, if you can invest in a fund $100,000 and get exposure to 10 or even 12 different assets. If you use direct investment, you need to invest the same $10,000, but in each type of asset. So you need 10 to 20 times more capital involved. And fund managers can also enjoy reputational benefits that see them secure participation in attractive investments unavailable to certain direct investors. That's a very important process called due diligence. I will give you here a brief explanation what it's about, and we'll talk in details about it during the last sessions devoted to the risk management, due diligence processes, and we'll see the examples of best practice both for the due diligence and for risk management. The basic question an investor must consider when investing in alternative investment is whether to rely on the expertise of the fund manager or to undertake the investment selection process themselves via direct investing. For direct investing, the investor has control over the choice of which company to invest. However, the due diligence process of making an investment in a private company requires considerable expertise. In contrast, funds offer diversified portfolios, due diligence expertise, and the negotiation of favorable redemption terms. But these benefits come with additional fees. And although funds offer due diligence on their underlying investments, responsibility still falls on the investor for conducting due diligence when choosing among funds to invest in. With co-investing, the investor is currently investing in a fund, but is given an opportunity by the fund to make additional investment in a portfolio company. In this case, the investor will conduct direct due diligence on the portfolio company with the support of general partner. A detailed discussion on due diligence will be in our later sessions. However, this session will provide a brief overview, and we will start with the manager selection. And the manager selection is a critical factor in portfolio performance. A manager should have a verifiable track record and display a high level of expertise and experience with the asset type. The asset management team should be assigned an appropriate workload and provided sufficient resources. Moreover, it should be rewarded with an effective compensation package to ensure alignment of interest, continuity, motivation, and throughout thoughtful oversight of assets. Fraud is always a possibility. The investor should be skeptical of an usually good or overly consistent reported performance. Third-party custody of assets and independent verification of results can help reduce the chance of investor being defrauded. Diversification across managers is also wise. Finally, separate accounts makes the shift more difficult because the investors retains custody of the assets and sometimes can select the prime broker or other service providers, binding them to the client's interest. And for investor considering a new investment, a proper due diligence process should be carried out to ensure that the targeted investment is in compliance with the prospectus and that it will meet her investment strategy, risk, and return objectives. Existing investors should monitor results and the fund holdings to determine whether a fund has performed in line with expectations and continues to comply with its prospectus. And due diligence for direct investing requires the investor to conduct a thorough investigation into the target asset of businesses, including both, but not limited, to the quality of its management team, the quality of customers, the competitive landscape, revenue generation, risks, and so on and so on. When considering direct investments in a private equity, the investor conducts reference checks and interviews to evaluate the quality of interactions between the businesses and each of its stakeholders. Due diligence for a private debt investing could entail credit analysis of borrowers to assess their ability to serve the regular interest and principal payment of debt, and background checks of the owners and management team would round out the effort. In direct real estate, the building's occupancy rate and the quality of its structure and tenants should be analyzed prior to investing. In infrastructure, an investor would perform an assessment of the quality of the assets held and operated, and the ability to generate future cash flow. In conducting due diligence, direct investors often supplement their due diligence with analysis prepared by external consultants. Now, I should say that that is really the case, and we can see as an example that I give to you during the investment project management session. You should carefully investigate the real estate assets, the efficiency of their management, operational processes, etc. And even in the cases of huge infrastructure objects like in airports, we can see sometimes that even if you have a good management team and if you have conducted a good economical research and you produce very modern and efficient equipment, infrastructure objects, etc., but you not delve deeply in some aspects of operational processes, like you don't get clearly the processes and the structure of human resources, how exactly the work shifts operate, and what amount of work shifts and specific personnel you need to run the business. You can face various unpleasant consequences. You can remember that we have a crisis in Sheremetyevo airport nearly 2 years ago, when the whole airport was stuck because of the lack of very small and probably not so significant at first sight type of the workers, like those who worked with baggage and provide sorting operations. But this bottleneck resulted in heavy delays in the whole airport. So just probably it was the question of not providing the thorough enough due diligence of not only the technical, financial, and other side of the business, but also human resources side. And what is the questions of due diligence in co-investing? Given that direct investing in a element is an element of co-investing, aspects of the due diligence process apply to both. In co-investing, investors often rely heavily on the due diligence conducted by the fund manager. Direct investing opportunities, however, are often sourced differently from co-investing opportunities, and so the level of independence sitting behind the due diligence can differ. Direct investment due diligence may be more independent than co-investing due to diligence because the direct investing team is typically introduced to opportunities by third parties, and they have more control over the due diligence process. Let's move on and discuss very important and very sensitive issue of the investment in alternative investment. It's legal structures used and the fee structure used. So the partnership structures in the world of the alternative investment, partnership structure are common. In limited partnerships, the fund manager is the general partner and investors are limited partners or LPs. LPs are more generally accredited investors, means owing to legal restrictions of the fund, and are expected to understand and be able to assume the risks associated with the investments, which are less regulated than offerings to the general public. The general partner, or GP, runs the business and theoretically bears unlimited liability for anything that goes wrong. The GP may also run multiple funds at the same time. Limited partners are outside investors who own a fractional interest in a partnership because this is based on the amount of their initial investment and the terms set out in the partnership documentation. LPs commit to future investment, and the upfront cash outflow can be a small portion of the total commitment. Funds set up as limited partnerships typically have a limit on the number of LPs allowed to invest in a fund, and LPs play passive roles and are not involved with the management of the fund. The operations and decisions of the fund are controlled solely by the general partner. This exhibit illustrates the limited partnership structure for a hypothetical 500 million investment fund. So you can see that we have a fund manager that is a general partner, and she invests 10 million, while the rest 490 million invested by the limited partners with various stakes from 50 to 90 million. The partnership between a general partner and LPs is governed by a limited partnership agreement, or LPA, a legal document that outlines the rules of the partnership and establishes the framework that ultimately guides the fund's operations throughout the life. LPAs vary in length and complexity and may be dense with provisions and clauses, some of which are discussed later in our session. And in addition to LPAs, side letters may also be negotiated. The side letter are side agreements created between the GP and the certain number of LPs that exist outside the LPA. Some examples of clauses of details that may be included in a side letter include the following. Potential addition reporting due to LP's unique circumstances, like regulatory or tax requirements. For example, we have some local authority as LP, and according to legislation, she must disclose in more detail than it's said by a general LPA. The first right of refusal or the similar clauses to outline potential treatment regarding fees, co-investment rights, secondary sales, and potentially other matters in comparison to other LPs. And there is a bunch of very interesting methods used for in the cases of deadlocks, when you have to resolve a conflict situation between the members of the partnerships, and the first refusal right is one of them. And if some of you is interesting, we can have a separate discussion later. For example, we have very interesting methods. For one of them called Russian roulette, how to solve these situations. So if someone want to discuss it, please give me a note and we can have it later. Other types of side letters can be a notice requirements if in event of litigation, insolvency, and related matters, and the most favorite nation clauses such as agreeing that if similar LPs paying lower fees, they will be offered to the LP. So to have the lowest possible fee from all LPs. Certain structures are commonly adapted for specific alternative investments. For example, infrastructure investors frequently enter into public-private partnerships, which are agreements between the public sector and the private sector to finance, build, and operate public infrastructure, such as hospitals and toll roads. In real estate fund investing, investors may be classified as unit holders, and joint ventures are partnership structure common in real estate direct investing. And it goes to the compensation structures. Funds are generally structured with a management fee, typically ranging from 1% to 10% of asset under management, or committed capital that's used for private equity funds, which is how much money in total that LPs have committed to the fund's future investments. On top of the management fee, a performance fee, also referred to as an incentive fee or carried interest fee, is applied based on excess returns. Private equity funds raise committed capital and draw down on those commitments generally over 3 to 5 years when they have a specific investment to make. Just note that the management fee is typically based on committed capital, not investment capital. The committed capital basis for management fee is an important distinction between hedge funds whose management fees are based on asset under management value. Having committed capital as the basis for management fee calculations reduces the incentive for general partners to deploy the committed capital as quickly as possible to grow their fee base. This allows the general partners to be selective about deploying capital into investment opportunities. So not follow the rule, use it or lose it, and deploy as much as you can to earn the highest fees. The partnership agreement usually specifies that the performance fee is earned only after the fund achieves a return, known as the hurdle rate. The hurdle rate is a minimum rate of return, typically 8%, that the general partner must exceed in order to earn the performance fee. GPs typically receive 20% of the total profit of the private equity fund net of any hard hurdle rate, in which case GP earns fees on annual returns in excess of the hurdle rate, or net of this hurdle rate, in which case the fees is calculated on the entire annual gross return as long as the set hurdle is exceeded. Hurdle rates are less common for hedge funds, but do appear from time to time. And in a section devoted to each specific type of alternative investment vehicle, either hedge fund or private equity, we'll discuss in details and calculate all these fees, and we'll consider both a hard hurdle rate and soft hurdle rate. So now we're giving only an overview on the whole variety of concepts within the alternative investments. Performance fees are designed to reward GPs for enhanced performance and to motivate investment professionals to work hard and stay involved for years to come. And this exhibit illustrates a simple example of how performance fees are calculated using a typical 2 and 20 compensation structure, where management fees are calculated as 2% of assets under management or committed capital, and performance fees are calculated on 20% of profits. So let us see in details. An investment that was purchased in year 1 for 10 million and sold in year 4 for 20 million represents a return of 26% on internal rate of return basis. The LPs receive 80% of profits, that is a multiple of 80% by 10 million equals 8 million, and the GP receives 20% of profits, that is 20% of 10 million, and it's equals to 2 million. And you see that this example assumes the hurdle rate be exceeded and the catch-up clause exists in a partnership agreement. And the next slide, I will explain what is a catch-up clause in detail. So the catch-up clause. The catch-up clause allows the GP to receive 100% of the distribution above the hurdle rate until he receives 20% of the profits generated. And hedge funds fee calculations also take into account a high watermark, which reflects the highest value used to calculate an incentive fee. And a high watermark is the highest value of the fund investment ever achieved at a performance fee crystallization date, net of fees by the individual LP. A high watermark clause states that the hedge fund manager must recuperate declines in a value from high watermark before performance fees can be charged on the newly generated profits. The use of high watermarks protects clients from paying twice for the same performance. In alternative investment, a waterfall represents a distribution method that defines the order in which allocations are made to LPs and GPs. And GPs usually receive a disproportionately larger share of the total profits relative to the initial investment, which incentivized them to maximize profitability. Just recall the previous exhibit where we have only 10 of 500 millions invested in a fund by the GP, while if we will have a catch-up clause and meet the all hurdle rate rules, then afterwards the GP will receive 20% of revenues and profits. Sorry. And we also have a clawback provision that reflects the right of LPs to reclaim part of the GP's performance fee. Along either waterfall path, or if the GP ever accrues an incentive fee on gains that are not yet fully realized and then subsequently gives back these gains, an investor is typically able to claw back prior incentive fees, accruals, and payments. Clawback provisions are usually activated when a general partner exits successful deal early on but incurs losses on deals later in the fund's life. Let's see how it works in detail. The catch-up clause. So for most alternative investment funds, particularly hedge funds and private equity funds, the GP does not earn a performance fee until the LPs have received the initial investment and the total return generated on the investment has exceeded a specific hurdle rate. In this example, the LPs receive 80% of the total profit of the fund plus the amount of their initial investment. So they receive all money invested back and 80% of the profit. A catch-up clause may be included in a partnership agreement. Essentially, for a GP who earns a 20 performance fee, a catch-up clause allows the GP to receive 100% of the distribution above the hurdle rate until he receives 20% of the profits generated. And then every excess dollar will be split 80 to 20 between LPs and GPs. Let us illustrate it. Assume, look at the exhibit, assume that the GP has earned an 18% IRR on the investment, the hurdle rate is 8%, and the partnership agreement includes a catch-up clause. In this case, LPs would receive the entirety of the first 8% profit. The GP would receive the entirety of the next 2% profit, because 2% out of the 10%, that is 18 minus 8%, amounts for the 12 of the profits accounted for so far. The catch-up clause stipulates, and the remaining 10% will be split 80 to 20 between the LPs and GP. And effectively, if we sum up all these things, the LP earned 40.4%, that is 80% of 18%. And GPs earned 3.6%, that is 20% of 80%. So you can see that the IRR, the total IRR of this investment split accordingly to the rule 80 to 20 between LPs and GPs. Let us imagine a scenario absent of catch-up clause. The LPs would still receive the entirety of the first 8% profit. However, the remaining 10% will be split 80 to 20 between LPs and GP, reducing the GP's return to 2%, that is 80% minus 8% times 20. And these calculations are graphically represented in this amount. So the catch-up clause allows GP to match her revenue stream to that of the structure set by the general distribution of profits between the GPs and LPs. So if you agreed with among the GP and LPs to have a split 20 to 80, and you are good on your investment and you meet your hurdle rates, so this clause helps GP to boost his revenue stream to match this 80 to 20 distribution agreed. And there are two types of waterfalls. One is this deal by deal or American waterfall, and another is a whole of fund or European waterfall. Deal by deal waterfall are more advantageous to the GPs because performance fees are collected on a per deal basis, allowing the GP to get paid before LPs receive both the initial investment and their preferred rate of return, that is hurdle rate, on the entire fund. In a whole of a fund waterfalls, all distributions go to the LPs as deals are exited, and the GP does not participate in any profits until the LPs receive their initial investment and the hurdle rates has been met. In contrast to deal by deal waterfalls, whole of fund waterfalls occur at the aggregate fund level, that is, after all investments have been exited, and are more advantageous to the LPs. You can see in this exhibit the difference between the American top and the European waterfall. So in American, the general partner receive its part of the profit earlier. You can see in year one, it's 2 million, then 3 million, n million, and then when the investment goes bad, he repays back using this under this callback provision minus 2 million, minus 1, minus 6, minus 4. But the difference is that the earlier you get the money, the more you can earn on that. So the time value of money aspect is also in place here. That's why this American waterfalls are preferred for the GPs than the European ones. Let us have a small break now for 5 minutes, and then we'll have a last section of our session today devoted to the potential benefits of alternative investment in the context of portfolio management. So let's meet at 8:50. So let us move on. So the key motivation cited for investing in alternative investment is their diversifying potential. And investors perceive an opportunity to improve the risk-return relationship within the portfolio context. Given the historical return volatility and correlation profiles of alternative investments, combining a portfolio of alternative investments with a portfolio of traditional investments potentially improve the overall portfolio risk return profile. The correlation between some categories of alternative investments and traditional investments has historically, over all long periods, been low, or at least less than perfect, providing diversification opportunity. I should make emphasis at this moment. The common words here is historically and over the long periods. It means that we can only observe historical correlation over the long period and see that it's low. It doesn't mean that in future or over the short periods in future, the correlation have to be low. So nothing for granted. Historically, it's low, but there is no defined rule stating that this correlation will be at the same low levels in future or any short period we will observe. And the times of crisis show it clearly that in a very short but very turbulent periods, the correlation between alternative investment and traditional investment can be not low, but as high as with any other classes of investments. And historically, higher returns by many categories of alternative investments compared with traditional investments result in potentially higher return to a portfolio containing alternative investments. And less than perfect correlation with traditional investments results in a portfolio risk that is gauged by standard deviation being less than a weighting of the standard deviations. So when you combine the alternative and traditional investment on a portfolio basis, you have less standard deviation that if you just have a weighted average of the separate standard deviation of various investment types. So let me remind you that the alternative investment have the following characteristics. It's narrow manager specialization, relatively low correlation of returns with traditional investments, less regulation and less transparency than traditional investments, limited or potentially problematic historical risk and return data, unique legal and tax consideration, high fees, and concentrated portfolios. And also, it can be restriction on redemptions. And if we can look at the historical data of these periods, we can say that identifying the appropriate allocation to alternative investment, the investment manager is likely to consider more than mean return and average standard deviation of returns. When considering potential portfolio combinations, the manager's analysis may include historical downside frequencies and the worst return in a month for potential portfolio combinations. The purported diversification benefits and improved risk-return contributions of alternative investments to portfolios explain why institutional investors such as pension funds may allocate a portion of their portfolios to alternative investments. There are challenges, however, including obtaining reliable measures of risk and return, identifying appropriate allocation, and selecting portfolio managers. It is important to note that expected diversification benefits from alternative investment are not always realized, including sometimes when they're most needed. Correlations between risky investments increase during periods of market stress and can approach 1.0 during financial crises. And you can see here in this exhibit three separate periods different by their nature. So we have steady growth in a period prior to the year 2007, then disturbance in the year 2007, 2009, it's a financial crisis, and then again a period of relative growth starting from the year 2010. And on the overall, for this long period from 1990s to 2014, we can see that the for hedge funds, their return is better than for bonds, while the standard deviation is pretty the same. We can see good returns for real estate and private equity with relatively acceptable deviations like for global stocks, and it's even better for the period of steady growth starting with from year 2010, where we have good returns on the real estate, private equity, venture capital with considerable with acceptable standard deviations, the same as on global stocks. But in the times of crisis in year 2007, 2009, you can see that the returns for the commodities, real estate, and private equity can be even worse than for global stocks, and the only type of assets that behaves good was the global bonds, and not hedge funds, not commodities, not real estate, no private equity, no venture capital can't meet this performance of the global bonds. So nothing for granted here. That's why it is important to have a different measures of efficiency at hand and the risk. So we can talk about the Sharpe ratio that equals investment return net of risk-free rate divided by standard deviation, and the Sharpe ratio is the common measure that is used in a traditional investment portfolio, but due to the nature of risk return profile of alternative investment, where you can have very probable but lower positive return with extremely large downside or negative effects, but with very small probability. So it's called fat tails. You cannot use directly Sharpe ratio. There is some additions suggested, like Sortino ratio, that is uses similar numerator that is Sharpe ratio, and that is mean realized return less target return. So if the target return is specified as a risk-free rate of return, the Sortino ratio's numerator is the same as the Sharpe's ratios, and it uses only downside deviation instead of the full standard deviation. So we're looking only on the bad tail of this distribution curve. And also there is a downside risk measure, such as the chance of losing a certain amount of money in a given period. That is also used in practice. And we will go in detail for these measures when we'll talk about the risk analysis of alternative investments. So we will welcome all these notations in the next sessions. I should also mention the two biases that are persisted to the alternative investment. It is a survivorship bias and a big fail bias. The survivorship bias refers to the upward bias of returns if data is included only for currently existing surviving firms. So imagine you have some indices that delete all the firms, funds, or the investment vehicles that are not survived. So all their bad performance was removed from the index, and that means the indices is biased upwards. Another type of bias is a backfill bias. It refers to the upward bias introduced by including the previous performance data for firm recently added to the benchmark index. So it's flip side of the coin. So you decided to include some fund or asset into your index, and its performance good. So you artificially probably or some fraudulently add its good performance for the past periods, while just from the investor point of view, if this investor follows the index for several years and he replicates the indices investing in a given proportion to the various types of assets that include in the index, and at some moment the index composer decided to include a new good asset in this index. This means that the performance for the whole period are shifted upward. But can we ask the investor, has he a possibility to invest in this good asset in the prior years? No, because that asset was not included in the index. So that means that even now we can see the good performance of the better performance of the index because we included a good asset. In the prior years, when the actual investment decision can be made, the investor hadn't such a possibility because there was no such an asset in the index. That is a backfill bias. At this point, I will end the lecture, and we have time to have a next quiz. It's a quiz for another 16 questions, and I would like to ask you, what is the better option for you, to have a paced quiz with me, or I can open this quiz and you can freely navigate it and make it on your own, and it will be open until the next session. So it will be open until Tuesday. On the Tuesday I will close it, and in the beginning of session on next Wednesday we can discuss the results of this quiz. So what is the best option for you? Good. Any other use? Good. Okay. So I will launch it right now. So there is open navigation, final score, and we're starting. So feel free to use the same link to the room and answer the question. It will open until Tuesday. That's all for today. Thank you for your participation. Thank you for your time. Please make your questions if you want to ask me something about the course, the exams, grading, about the alternative investment. I'm happy to answer you. Yes, I have a list of your emails. I will combine it and send today's slide to these mails. If someone didn't get it, please share between you, among you. So, okay. Thank you so much. And have a good evening. Yeah. Okay, I'll include it. Okay. So thanks again. Bye-bye.